The stock market can seem like a mysterious beast, but it's actually pretty straightforward. Companies need money to grow. They get this money by selling shares of ownership, called stocks. These stocks are traded on exchanges like the New York Stock Exchange. When you buy a stock, you're buying a tiny piece of that company. If the company does well, its stock price goes up. You can then sell your stock for a profit. Of course, the opposite is also true. If the company struggles, the stock price may fall. There are two main ways to make money in the stock market. First, you can buy low and sell high. This is called capital appreciation. Second, companies sometimes pay dividends to their shareholders. Dividends are a portion of the company's profits. Remember, investing always involves risk. It's crucial to research and understand the companies you're investing in. Diversifying your portfolio is also key. Don't put all your eggs in one basket. Imagine trying to understand the stock market by looking at thousands of individual stocks. It would be overwhelming. That's where stock indices come in. Indices track a group of stocks, giving us a snapshot of the overall market. The Dow Jones Industrial Average, or DJIA, is one of the oldest and most well-known indices. It tracks 30 large, publicly owned companies based in the United States. The S&P 500 is broader, tracking 500 large companies. Finally, the Nasdaq Composite focuses on technology companies. These indices can tell us a lot about market sentiment. If the indices are up, it generally means investors are optimistic about the economy. Conversely, if the indices are down, it suggests pessimism. It's important to remember that past performance is not indicative of future results. However, understanding these indices can help you make more informed investment decisions. The stock market doesn't exist in a vacuum. It's heavily influenced by the broader economy. Factors like trade policies, inflation, and interest rates can all impact stock prices. Trade policies like tariffs can impact companies' profits. For example, tariffs on imported steel could hurt the profits of American car manufacturers. Inflation, or the rate at which prices increase, can also impact stock prices. High inflation can erode corporate profits and make investors nervous. Interest rates also play a crucial role. When the Federal Reserve raises interest rates, it becomes more expensive for companies to borrow money. This can slow down economic growth and hurt stock prices. Understanding these economic factors can help you anticipate potential market movements. However, it's important to remember that the economy is complex and unpredictable. So what does all this mean for you, the investor? Whether you're a seasoned pro or just starting out, there are strategies you can use to navigate the market.